Frank Cipolla, the Federal Reserve meeting this past week. They met and they're sending the markets into a tailspin after Fed President Bernanke indicated the Fed may be ready to start winding down its popular bond buying program.
The conclusion of a two-day policy conference had Federal Reserve Chairman Bernanke offering a grim outlook for the immediate future of the U.S., largely due to a poor job market.
Unemployment is still too high, but it has come down. It was about 10% at the peak, and now it's closer to 8%. It's going down too slowly, but it is going down. People are finding jobs, but just not at the rate that we would like to see. And you know, as I said, and as the statement says, if we don't see continued improvement in the labor market, we'll be prepared to take additional steps if appropriate. Back
in April, the Federal Reserve had suggested the U.S. economy would grow by 2.9%. They have cut that number down to 2.4%, particularly as the number of people seeking unemployment benefits has increased to 5% over the past 6 weeks. Bernanke added that a program designed to lower interest rates will be extended in hopes of stimulating borrowing and spending.
As indicated in the statement released earlier this afternoon, the committee is maintaining a highly accommodative policy. We decided to keep the target range for the federal funds rate at 0 to 1/4%, and we continue to anticipate that economic conditions are likely to warrant exceptionally low levels to the federal funds rate at least through late 2014.
Now joining us to discuss this, Republican strategist Dee Bernanke has joined us again. And this time around we have credit expert Paul Oster from Better Qualified in Eaton, New Jersey. And Robert Miller, who is that is Paul Oster right there. This is Robert Miller. He's the sales manager at Residential Home Funding, one of the major banks in the state of New Jersey as well. This is an interesting story. The Fed president, I mean, the market has been going up and up and up. It's doubled in the last few years. And now the Fed president says, you know, maybe we don't need this continuous bond buying program to stimulate the economy. Maybe it's strong enough. We're going to take the training wheels off and see what happens. And the markets plummet. The Dow Jones Industrial is down more than 5% in 2 days. Was this a wise move, or is this just he's letting them know early on so that the markets and investors can get ready for this? We'll start maybe with Robert Miller on it.
The reality is that nothing happened here. They made an announcement that everyone knows what's coming. We know that they're going to take the brakes off. Put the brakes on at some point down in the future. They moved the bar a little bit on the unemployment number, which was typically at the 6.5%, and now they've moved it up maybe to 7%. And the mortgage-backed securities and the bond market is in full meltdown mode right now. This is not reality. It's just not logical what's going on. It's a little bit, way bit of an overreaction.
So Paul Oster, was this an overreaction on Wall Street? Do you concur?
I totally concur. I mean, we can't stay at a 0% interest rate. The environment is just not conducive moving forward. The more money that goes into the government, they keep buying these bonds, it's the worst it's going to be for the economy in the long run. So we all know it's coming, like Robert said. The reaction, everything is so emotional because the fundamentals are still so fragile right now. So something like a non-action has the effect.
Well, you know this, and you know this, and the panel knows this. Why do investors, why did they act so surprised that this might happen?
That's anybody. I mean, I don't know if anyone knows the answer to that, just like no one knows the answer to how you know, we're ultimately going to get out of this mess. Why did they react like that? I don't know. When he's been hinting to this, he did it the last time that he spoke.
Now, Robert, this reminds you of when I used to take my son to the fair, and he wanted cotton candy before he wanted his meal. Has Wall Street become addicted to this sugar rush?
Wall Street is addicted to this right now, and just the thought that this might end, this may start ending, has sent everyone into panic. And I think we have to come back to reality at some point. This is going to end down the road, but nothing has changed. Nothing has ended right now. What we're seeing now, at least from a mortgage rate perspective, is a change that I would have expected once we actually did start to scale back, and we haven't even started to scale back. If we're going to endure this kind of change with just pure speculation and the fear of the impending scale back, let's do it now. I mean, scale back now.
It could be the uncertainty.
Republican strategist Dee Bernanke, I'm assuming as a Republican strategist you just love the fact that the Fed is continuing to print money and have for a while. You must be pleased that Fed Chairman Ben Bernanke has said, you know, somewhere down the road, probably late this year, we're going to start weaning the folks off.
No, much more than that. I don't know why they did it to begin with. I mean, because it didn't do any good. Now we're going to be in the worst place.
There are indications that it did help the recovery.
Well, but guess what happens whenever they take us off of it? Disaster. I mean, that's not good because we've got low interest rates. But then what happens when they go up? Especially in our debt, we can't handle it. It would have been better to have a true capitalistic free market and not have the government intervention. So in the end, this is going to do more harm than good. So yeah, we're going to have to go off of it. Guess what happens when we do? Not good, and that's why the market tanked. Should have not done this to begin with.
All right, do you say that? Do you agree? Will it be bad for the average consumer once this ends?
Absolutely.
It will be.
I don't agree that we shouldn't have done it. I just think we've prolonged it. You know, and maybe the answer to your question before is it's the actual uncertainty. If he would have just come out and said, you know what, tomorrow we're starting to pull back, then people can plan for it. But the velocity, whether it's up or down, in which we're moving right now, is not good. We can't sustain it either way. So put something in place and go, and then people can prepare and plan to be in a new environment.
Well, are we all in agreement that this should be a slow process of weaning us off, or should they set a date and say, as of this date, we're not going to do this?
It's already been too slow, like what you said. It's been prolonged. I think we should have done it at all, but if you're going to do it, don't do so much of it. It's already been prolonged too long. We have to get off the sugar. We have to get off the opium, because guess what? When we get off the opium, we're not going to be feeling too well. I mean, so it has to stop somewhere.
So where do you see interest rates going when they start? Both of you are involved in.
Robert probably knows.
Robert probably. Where do you
He
see
watches
interest
them.
rates going when the Fed starts weaning us off there? Will they be
Well,
a panic in
obviously,
the other direction?
They're going to start going up, obviously, once they start weaning us off this. And I'm not so certain that the rise that we've seen over the last 4 weeks, for that matter, is really the impending rise that's coming. And I do think we're actually going to see rates soften up a little bit, and I think they're going to fall. It's going to take a little bit longer than I initially had thought, because this has been such a movement beyond reality. So I think that we're talking about a 60 or 90-day window before we see rates come back down to maybe where their new bottom will be. And I've said for a long time that the next time rates do come down, for however long that is and for however low that is, that may very well be the last time. Because this is going to stop eventually. It does need to stop eventually. There's no question about that.
Well, isn't it a stimulus for Americans
Try
as well? If
bailout.
I'm looking to buy a
Yeah.
home and I have an inkling that this might end soon and interest rates are going, I might move my plans ahead a little bit and say, let's start looking now or during the summer, because we don't know where the interest rates are going to be.
But the interest rates are going up right now. There's no question.
They're creeping up. They're not really going up.
They're doing more than creep up in the last few weeks or so. But at the moment, the biggest problem, at least from the inside this industry, is that we can tolerate higher rates in this industry. It's not a problem. We've done it back and forth for a century. But we need to open up the credit box if we're going to have higher interest rates. If we don't open up the credit box and we maintain these current lending standards with higher rates, we are going to have a housing problem.
Now, Paul, you deal with people who are struggling with credit all the time as a head of credit, betterqualified.com, but you see this all the time.
Yeah.
What would you recommend to your clients? Should they move now and do this while they have the opportunity?
Absolutely, but you know, just to touch base on what Robert was saying, the people that are getting hurt the worst are the people with average to not so good credit right now. They continue to pay higher and higher interest rates, much higher than someone with excellent credit right now. So if that trend continues with the higher interest rates, the market is going to implode or certainly dry up very, very quickly. And the difference between, you know, the long-term interest rates and the bond market that directly affects mortgages, fortunately, perhaps the short-term interest rates, the prime rate, the credit cards, might stay low, even though, you know, the long-term rates are going to go through the
Well, Robert,
roof.
let me ask you about lending. I've had friends of mine with fairly good credit, some with very good credit, who have jumped through so many hoops, and at the end the bank has said, no, we're not going to lend you the money anyway. Why is it so difficult to consolidate loans, to make a bigger mortgage? Why is this suddenly so hard? With all due respect, after giving the banks, most of them in the United States, $700 billion and not getting any of it back.
The real problem that we have in this industry right now that doesn't seem to be addressed is that banks are not going to loosen up on the lending standards, because right now the pressure on them is immense from the larger subsidized entities, Fannie Mae and Freddie Mac, for buyback demands. Buyback demands have put an terrible
Explain
drain
that
on
for us,
affordability.
buyback.
Well, essentially, this is a lender underwrites a loan, they write a mortgage, and then they usually package these loans together and sell them to Fannie and Freddie.
Right.
Fannie and Freddie, throughout history for most of the time, would go back to the lender on the cases of fraud. You didn't do the right work here. Over the last 3 or 4 years, we've seen where they come back for reasons that are just, you didn't dot the I and cross the T for completely silly reasons. And lenders are now overreacting to that and over scrutinizing files to try and prevent any possible excuse of a return from Fannie and Freddie. And right now, there is no private money in the mortgage industry. Until we get some private money and give Fannie and Freddie some competition, that's not going to change. If that doesn't change, lending standards aren't going to change. And we need something to give if rates are just going to climb.
Well, if interest rates are going up, it's just going to make matters worse.
Yep.
Yeah, there's no question. So what's to do about it, though?
They're trying to
Obviously,
create a
that's the problem.
zero risk environment, and that's impossible when you deal with mortgages. Things happen over time. We never want to go back to, let's call it the wild west days, but the current environment is ridiculous.
Well, I don't know why we have to go from the Wild West to insanity right now.
Well, that's just the way our
obviously
government is.
But true, but
Everything
why?
we do.
That's why they need to get out. You just made my
You
point.
make a very good
We
point.
need make sense underwriting right now for lenders. If they can, an underwriter should be able to sit down and say, can this person afford this loan? And that's not the
All
case
right, we're
right
going
now.
to give Dee Dee the last word. This all goes back to politics and some politicians who don't want to make the hard decisions. Do you see them stepping up to the plate, or we're going to have more of the same in
I
Washington?
just think we need to get rid of some of the regulations on companies, and the government needs to get out. The bank ballots don't work. Look, they're not releasing the money. So they get this money, they didn't release them. So none of these bailouts work. The government just needs to get out of business.
Well, some of
and
the
get out of
bailouts did work. General
but they
Motors
didn't.
paid back a lot of the
great. Yeah,
interest
the government
rates
needs to get in the
and
car
made
business.
money.
That was a disaster.
AIG paid back, and the government made money on the AIG bailout. So
But we end up losing in the end because our debt goes up. I mean, and then we have problems like this. I mean, this did not help. Now we're going to go back to the drawing board and probably worse.
all right, Dee Dee Benke, thank you. Robert Miller, president, or I should say manager of Residential Home Funding. We appreciate you coming by. Paul Oster from BetterQualified.com in Eaton, New Jersey. Thank you.
Thank you.
Thank
This
you.
was a learning experience for everybody. And Fresh Outlook is coming back, and when we do, we'll talk about the Superman movie and why we need heroes. We'll be right back.